Good morning, good afternoon. It's my pleasure to be here with my colleagues from the research for this new monthly preview webinar. I'm Cyril Regnat, I'm heading the market research, and today we'll be focusing quite a lot on the US economy, on the US bond market with two of my colleagues from our New York office. Christopher Hodge, our US chief economist. Hi, Chris. Welcome on board. And and John Briggs, who joined us earlier this year. Hi, John. Good to have you here as well. So, big focus on the US economy, on the Fed, and of course the price action we had following this FOMC meeting. And we'll still speak a bit about Europe, and the one covering Europe for this call will be Théophile Legrand, our rates strategist based in Paris. Good morning, no, good afternoon.
Hi, Cyril. Hi, everyone.
So let's start right away with you, Chris, about this US economic outlook and this FOMC. So the Fed delivered 25, but well, the discussions or the message of the Fed is not that clear. Looks like there's still some maybe debates surrounding the Fed capacity to deliver the market expectations.
Thanks, Cyril. Yeah, obviously the focus has been on the Fed for this week, and I want to do a little bit of table setting about the growth that we've seen so far and the growth that we can expect in about the next year and a half or so. So as you can see here, we do expect a slowdown in growth for the rest of this year. We should also expect below potential growth somewhere in the mid ones throughout 2026 as well, but certainly far from the collapse in growth that a lot of people prognosticated because of some of the administration policies. Let's head to the next slide, please, Cyril. Now, one of the reasons that we do project a slowdown in growth is because there are pockets of weakness, particularly in the consumer sector among low-income earners. So you can see here that we've had an uptick in delinquencies for auto loans, student loans, credit card loans, mortgages, et cetera, et cetera. The chart on the right shows the share of credit card holders that are now making the minimum payments. So this is a sign of stress. But if we do, compare the left chart to the historical trends, we're moving upward, but we're not flashing any sort of red signs here as well. We're looking at a marginal weakness for the bottom quartile of consumers in the U.S. Next slide, please. Now, this shows that the incomes and net worth and also spending is being driven by the wealthiest consumers in the U.S. The baby boomer generation is the largest and wealthiest cohort in the U.S., and their spending is fairly insensitive to the business cycle overall and to interest rates. Most of their liabilities are in fixed rates. Most of their assets are tied to floating rates. So they've seen a very large increase in their net worth overall. And if you look in aggregate, consumer debt doesn't look all that bad as well. So balance sheets for the consumer do look pretty good overall, but we do expect a slowdown in spending due to precautionary savings going up based on some warnings that we're seeing from the labor market. We can go to the next slide, please. So speaking of the labor market, we have the chart on the left showing payrolls by sector. So we've seen this steadily come down, and the last couple prints is what really has prompted the Fed into restarting the cutting cycle. So we have seen a pretty big step down in payrolls, payroll gains, and the payrolls, or the jobs that are being created, are disproportionately being created in the healthcare and education sector. Now, this is a sector that's pretty immune from business cycle pressures overall, and more a function of demographics. Now, we do expect payrolls to stay low. We think a run rate of about 20 to 40,000 jobs is about appropriate given the slowdown in the workforce overall. So even though this is a little bit scary, we don't think it should be all that frightening for policymakers because we don't see any sort of labor slack emerging. Next slide, please. So we are in this very low churn environment for the labor market. Businesses are very hesitant to hire, but they're also hesitant to lay people off as well. And I think this is partially because there's still some scar tissue from the post-pandemic period where there was a labor shortage and businesses had to pay up for employees. Now, given that the economic slowdown is expected to be short and shallow, we think that businesses, unless they're forced to because of really large compression of margins, we think they're going to be inclined to hold on to employees. So those that are out of work, as you can see the continuing job claims here to the left, those that are out of work are finding it more and more difficult to get back into the labor force, but we also don't see layoffs ticking up. Next slide, please. And this is just another indicator of labor slack. So we do see a little bit additional slack, but wage gains are still pretty solid at this point. They've come down, but they're not trending down anymore, and we expect this trend to continue. Next slide on inflation, please. So we have seen an uptick in goods prices recently, but we've also seen an uptick in service prices. So for the goods, this can be largely attributed to the application of tariffs. And these tariffs, the impact of these tariffs, I think we're going to see, maybe until the end of Q1 2026, the tariffs were applied very unevenly, and we can expect the impact to be felt on inflation in a similarly uneven factor. But as companies need to restock inventories at higher prices, we do expect these to be passed along to the consumer. And as I mentioned on one of the previous slides about wages, there's more of a direct link between wage pressure and service inflation. So I don't expect that. I don't expect the prices for services to continue to disinflate. I think they're going to stay at a fairly high level. Down to the next slide, please. Now, getting more to near-term policymaking, the huge disparity that we see from Fed policymakers is where is the short-run R-star? So longer run, the Fed still thinks it is 3.0, but there are cyclical trends such as the very high budget deficits that we see, the slowdown in immigration, the changes in demographics that may make the short run R-star a little bit higher. So that's really the big debate going on right now is how restrictive is policy. Down to the next slide, please. Now let me switch to what we've experienced or what we saw Wednesday from the Fed and what we can expect going forward. So the FOMC meeting on Wednesday was a pretty strange one. On net, it was pretty dovish, but not overly so. And it's really hard to have many strong takeaways. Starting with the official statement, the labor market vulnerability was pretty explicit in being highlighted a few times. The summary of economic projections, or the dots, showed 2 more cuts for the rest of the year. And that's definitely not a promise, but I do think it's a baseline for the Fed at this point. And the burden of proof is going to be on the labor market to show more resilience for the Fed to not cut. So if there is any additional softness, if we do see the unemployment rate ticking up to 4.4% or higher, I don't think the Fed's going to be very hesitant to cut. But there was a hawkish minority of 9 of the participants who favored 0 or only 1 more cut for the rest of the year. So this is a very split dynamic on the FOMC. And I think the key takeaway from this is, despite the Trump administration trying to undercut Jerome Powell, he's obviously not going to be the chair in the second half of 2026. But this is still a committee where Powell has a lot of control over it. He did manage to muster a majority to his preferred path. There was only 1 dissenter, and that was from Stephen Myron, who's on loan from the executive branch, and he wasn't put on there to be hawkish. So the outlook for next year for the dots was also very interesting. So we had an uptick in the projected core inflation for next year. We had unemployment staying the same. And we had growth going up. Now, the reaction function from the Fed was for rates to go down even further. So this is a Fed that, on net, and with the caveat that it's always hard to glean a full narrative from a composition of various predictions that form the dots. But this is a Fed on net that is more comfortable with inflation being above target. Inflation's been above target for 53 straight months now, and the Fed doesn't project it getting back down to 2% until 2028. So Powell did mention that this was a risk management cut, and the market didn't seem to like that very much. And I think that might be a little bit of a misreading. I don't think that this is a one-time insurance cut necessarily. I think this is a sign that the Fed is prepared to preempt any additional stress in the labor market by providing cuts. So Powell overall was pretty cautious not to overcommit, especially given the genuine divide on the committee right now. But I think the key takeaway is that, at least for the near term, for the next 3 or 4 meetings, this is Powell's Fed. And any additional labor market weakness that we see is going to be met by the Fed reducing policy rates. I do think the Fed's going to get back down to a terminal rate at about 3% sometime in 2026, and that's going to depend on the resiliency of the labor market and whether or not we see more acceleration in inflation. So our base case right now is that inflation does stay elevated throughout 2026, but we have unemployment reaching a peak of about 4.8%. All things considered, I don't think that this should be met with a dovish Fed, but I think it will be met with a dovish Fed, and I think the Fed gets back down to 3%. Given the very wide dispersion of views that we've seen so far, it's very hard to predict the Fed's reaction function. But that is our base case at the moment. And let me stop right there. Oh, let me just mention one more thing. Stephen Myron had the dots for 2026, or sorry, for 2025. He's projecting 5 more cuts by the end of the year. That was dismissed by a lot of folks watching this as being a bit of an outlier. And while it's certainly an outlier, I don't think it should be dismissed. We are going to have a pretty big shift in personnel in Fed throughout the next 12 months. And if this is a sign of the type of people that President Trump is going to appoint, then we should expect that the reaction function of the Fed is going to be more dovish. So let me stop there and toss it back over to you, Cyril. Look forward to having some questions later on in the discussion. Over.
Sorry, I was on mute, but thank you very much for your insight, Chris. So Fed will be cutting down to 3% by maybe April or June next year. What does it mean, John, on your side, for the US bond market, knowing that market expectations, if I go back to this slide on the right-hand side, are pretty close, in fact, to our scenario. Does it mean we should add some long position on the front end of the curve in this context? What is your view?
Yeah, thanks, Cyril. And thanks, Chris, for setting the table so well for me. Yeah, the answer to your question is not yet, and I'll explain why. This is just our basic U.S. rates outlook grid, and I've highlighted kind of the 2 benchmarks that most people look for are a good context for this discussion. So starting with the front end, as Cyril focused on, we do see 2s following the Fed path lower, with the market slightly anticipating the cycle, as it always tends to do. Now, back in July, when 2s were around 4%, and Chris was calling for a September cut, and even then calling for this cycle to get down to 3%. Based off that, we recommended longs in the front end. We were also closer to 3.94% at that time. Now we've moved down to closer, 3.5%. And despite in addition to the fact that that's where we felt that the front end and 2-year notes would be closing for this quarter, more importantly than anything, when Powell characterized the cut as a risk management move, that they're going to look at things meeting by meeting, essentially signaling that this was not, on a preconditioned course, or that they anticipated a full cycle. And we do think they will have a cycle getting down to 3%. But his communication on Wednesday was not enough to get the market to price that in further. Now, the market had priced terminal going into the meeting around 280. So, those kind of commentaries was certainly not dovish enough. So we had previously recommended longs for 2 years around that 4% level. We recommended closing that. And again, we do see lower front end yields down the road. We just think that for now, the market's well priced. It's a negative carry environment for the front end, and we think we'll get better entry levels. So we're not necessarily bearish on it, but do think that the market could be due for a pullback here. And as we've seen, multiple times over the course of this year, the ebb and flow of the data, or even just the randomness and random walk sometimes in some of the data, we think we'll get better entry levels. We don't think we'll get back to 4%, but something like 375 is something worth considering at the time. But I will say, when we talk to clients, and since we put this out originally back in July, where we get pushback was never really necessarily on the front end, but really on the long end of the curve. And if you look at the 10-year yield box, you'll notice that we don't have 10 years trading below 4% really at any time over the forecast horizon. Now, to be clear, I don't doubt that at some point 10s could trade below 4% at some point. I mean, you could possibly count the other day where we maybe had 3.998. But my point here is really that if we assume the Fed funds rate goes to 3%, what I'm trying to get across even just through this forecast is that we don't see much value in the long end here. And to be honest, previously I was more convicted on the direction of the curve, but now I have even stronger conviction on curve steepeners. And that only increased after the Fed meeting. Next slide, Cyril. Now, we know curve steepeners are popular. There has been some fairly large position unwinds of late, but I actually see them working over 3 separate time frames, or the arguments behind them are over 3 separate time frames. Short term, now normal curve steepening associated with the monetary easing cycle. This is accentuated to me by the fact that they're easing into still above target inflation. Just this meeting, the Fed raised its 2026 inflation forecast, lowered its 2026 unemployment rate forecast, and signaled more easing to come. I mean, that's kind of a textbook curve steepener, more inflation risk down the road type environment. As you can see on this chart, we're really only partially along just even the normal process of an easing cycle, and never mind the inflation side of things. Next slide, please. And over the medium term, I do think that this story about pressure on long duration sovereign bonds is going to continue. Now, this is not something that is going to happen every day. It's going to be periodic. It's going to be episodic. I'm particularly watching the UK as canary in the coal mine. I mean, we saw the borrowing numbers today. I think the autumn budget's going to be another inflection point. And I don't necessarily think this has to be a crisis, so to speak. And I also think it's going to evolve in different ways in different jurisdictions. In the UK and Japan, different parts of their monetary cycle is part of it. We could see outright yields rise. In the US, it could just be the fact that US long yields don't take part in the easing cycle, which is kind of how I see things. I see the long end generally trading around here in broad ranges, while the front end gets most of the benefit of the monetary easing cycle. It's a little strong for me to say that I think that this is a reemergence of the global bond vigilantes, but that's kind of what's happening in the background here over the medium term. Next slide, please. Now, longer term, I believe that we are shifting to a new regime from the post-global financial crisis regime, which basically lasted between then and COVID. And this is only partially played out so far. It's really a term premium story. Higher volatility in the inflation data, a more inflation-prone economy due to lower labor force growth, deglobalization, ongoing tariff risks, a myriad of reasons why, not necessarily to be more inflationary, but be more prone to inflation shocks. An overall more volatile environment geopolitically, certainly more volatile US policy environment, fiscal policy, tariffs. Also, you can throw in the risk of more politically motivated Fed chair, potentially compromised Fed independence in general, lack of QE, less forward guidance. I just think there's a lot of reasons why over time, and this is even going to play out even more slowly, but just in the background that US rate market is going to come out the other side of this over the next couple of years in a higher term premium environment. And with all the stuff that I listed, I just don't think that 50 basis points is enough compensation for an investor to go to a 10-year note versus a 2-year note. So if you believe the Fed is going to head to neutral around 3%, I just don't see any value in necessarily investing in 10 years below 4%, unless you're just looking for that plain old nominal return. Again, I just feel like over several time frames, all the juice in the cycle is going to be, say, in the 5-year sector and I just really don't have any interest in owning the long end. And in fact, I worry about the very long end of the curve, US 30 years, actually rising in yields over time, no matter what the Fed is doing, right? And in some cases, because of what the Fed is doing. Next slide, please. Lastly, tying in all of that I've mentioned so far into inflation expectations and market inflation, this all translates in the same way. I do think that we are similarly in a new regime for inflation post-COVID, I should say for market inflation post-COVID, or at least the equilibrium for inflation compensation, inflation hedging has risen. Is it a lot? No, but I think it's pretty clear, even the evidence so far, you've gone from someplace where, you know, market is centering around inflation to be around 2% to inflation is probably going to settle in around 2.5%. Now, as Chris mentioned, with the Fed target, with inflation above the Fed's target for many, many months now, should it be higher? You could make that argument. But in the very least, I think that if you're looking to pick up hedges against inflation or inflation staying sticky in the US, I do think anything around that 2.5% is going to be a solid move to hedge portfolios. So again, we're a little rich probably here in the near term, but tying in with the whole rest of the story, we are favorably inclined to inflation hedging in the US. That's the main narrative here, and I look forward to welcoming any questions.
Thank you very much, John. We will be taking, of course, some questions after Théophile's round on European rates. So maybe in order to switch to this new topic, we've seen ECB as well being rather cautious or a bit on the hawkish side once again. Now that the Fed is cutting rates and we potentially have this bullish momentum abroad, does it mean that we should expect the European market to be a bit more resilient ahead, or do you think that we'll keep having this decorrelation between the US and European market ahead?
Well, thank you, Cyril. Starting directly to the recent development from the latest Governing Council meeting of the ECB, we have three key takeaways to discuss today. The first one is the Governing Councils has assessed the risk to growth are becoming more balanced now, which suggests that there is a growing confidence in the economic outlook, and this is a noteworthy shift that could influence the market perception moving forward. The second theme is that the ECB inflation outlook remains largely unchanged, with medium-term staff inflation projection confirming the inflation is expected to over near the target, and this is continuity suggests that the ECB is not overly concerned about inflation pressures at this moment, and that's the main difference versus the Fed. The third, also, President Christine Lagarde reiterated that the current policy rate is in the good place. So, and this statement is also reinforced the belief that the ECB is likely to maintain its current rate in the near future. But given the context, we forecast that ECB also there's still a risk for the ECB to cut rates, because we see like further rate cuts are still a possibility that would require a significant trigger that's such as the sharp decline in activity data or some undershooting of in inflation. And our economists are currently assigning a 60% probability of rate cut in December, potentially driven by lower energy prices and a stronger euro, but that's definitely a close call. And if we look now at the market perception and our attention to market expectations, our Esther forward curve suggests that the market is currently pricing 11 basis point cut by mid-2026, signalating the higher likelihood for the ECB that the ECB has already completed its current cutting cycle. And also, if you look at the chart on the right, that the Euribor front, that the market is expecting the ECB will keep interest rates stable through mid-2027 with a potential rate hike instead, but this is very, very limited for now. So market is having a growing confidence that ECB is likely to maintain policy rate stable for at least 1 year or 1 year and a half, and that's the main, of course, difference through the Fed, as the Fed has restarted its cutting cycle. Moving into the next slide, of course, on the long-term euro rates, and particularly with the respect to Germany. And following the recent sell-off in the US, the Bund has climbed back to above 2.70% and is establishing on the upward trend. And the Fed recent cut was initially perceived as a signal for a renewed cutting cycle, but however, the message, and Chris mentioned it, was not straightforward as anticipated, oscillating between risk management and the reassessment of inflation trajectory. And looking ahead, of course, the market focus on euro rates will likely to stay focused on the German fiscal package and its implementation velocity. And you can see on the both charts that we made some estimates on the impact of additional supply of Bund and the impact on the term premium, and our estimates suggest that an additional 100 billion in Bund supply could contribute to a 35 basis point increase in the term premium. And consequently, if we maintain, if we see a risk of last cut between a risk of last cut and ECB on hold, we project, given that risk, we project the 10-year Bund yield at 2.85% by the end of this year, and targeting 3.2% by the end of next year. So that's the main view on the 10-year Bund and the long end. And now we can move into the next slide. Now let's examine a bit the fast money positioning index. And firstly, there are three main information is this table, which is quite interesting, because firstly, we observed some profit taking in the 10-30 steepeners in both US and euro rates last week. This could lead to short covering in the 30-year UST and the Buxel, which is the 30-year Bund, as the market has shifted into long position since last week. So that's the first information from this. The second information is that the market is accumulating some short position in the 10-year Bund future, especially when last week the 10-year Bund reached 2.65%, so which could be a support for fast money community to reconsider some short position, and this supports our outlook for higher Bund yield by the end of this year. And lastly, and the third information is that fast money remains long on US rates and versus euro rates, so which is currently suppose some tightening pressure on the 2-year UST charts, and some potential again from also tightening in the UST Bund market. And the recent correction in the US rates indicate that a likely profit-taking phase, while a resurgence in this rate will aim to support to the rise in euro rates. And overall, this sentiment align with our medium-term view that euro rates will remain on the upward trend. And moving into the next slide, of course, we can address, we talk a lot about France over the recent week, so I will spend only some minutes on this, but we expect, of course, the divergence to persist on the 080 Bund spread and the broader EGB's universe, because attributed to the ongoing government fragility. So first, the prevailing sentiment suggests that we have a structural weakness in French government bond markets linked to the institutional challenge, but overall, this concern is already priced into the OAT spread versus bond, but notably the market exhibited a lack of response to Fitch downgrade last Friday, and the market reaction was relative muted, which is suggesting that the lot of risk may be somewhat priced in. Of course, market will keep an eye on the French macro outlook, coupled with a difficult political landscape. But our view on the spread is that we maintain a slightly short bias on the OAT bond spread, as we target 85 BPs by the end of this year. And we will look also on any consensus on the budget at this stage that could likely to give a compromise, and we will see what could be the efforts that we will bring the efforts to reduce the French public debt. And talking also about broader EGBs overall, we can go on the next slide. We see that also the 10-year OAT bond spread has not reached level seen last December, when the OATs have been very rarely cheap, but we can see that a clear sign of OAT cheapening, more affordable against other EGBs, and this is quite evident if you look at the current spread versus the Spanish bonos and also the Italian BTPs. And we can see and we can describe two distinct dynamics are now at play. And on the one side, of course, you can see that an improvement in fundamentals of peripheral bonds with favorable sovereign credit rating, notably upgrade last week from Spain and Portugal, and potentially also an upgrade this evening by Fitch on Italy. So that's something very interesting, as some structural Fitch shift into the sovereign spread overall and the peripheral spread overall. And we can go on the next slide. And finally, this is completely linked to the current situation that we are observing into spreads. We assess a bit the appetite on the non-resident investors. And starting with BTPs, we can see that data from the Bank of Italy reveals that since mid-2022, non-resident investors have been accounted for around 200 billion euro of the additional of the 300 billion in outstanding BTP. So while non-domestic financial investors have been more muted overall. So of course, non-resident investors have been key drivers of the tightening of OAT bond spread, and this also in line that we have a strong demand from foreign investors. I saw that Eurosystem has reduced its holding by more than 100 billion since the beginning of the QT, and the trend in foreign investors have been accelerating since the beginning of the year, because we see like a surge by around 80 billion euros. Also, moving to the next chart on the left, you can see also that foreign investors have been key supporters of OAT over the past 3 years, and also growth was initially halted last year during Macron call for new snap election. You can see like a stabilization of a foreign investor appetite in June 2027, and after the demand was growing, potentially both boosted by favorable conditions from sovereign credits. But that's the key message on this chart, is that of course we have uncertainty that could remain regarding the potential credit rating on France, and some, again, downgrade of the French gauge, which may impact non-resident flow overall. So for now, we don't have the response that how the non-foreign investor will behave against the French OAT, but also you have also to keep in mind that some domestic investors, excluding banks, have have not increased their exposure to OAT. It's more like domestic banks that have been more active into the OAT market. So of course we will keep an eye on the on flow and OATs, BTPs, and other EGBs flows, but that's quite interesting for now. And last slide to sum up our key view. Of course, as I said, that we are expecting the 10-year bond to increase by 2.85% by the end of this year. We target 3.2% by the end of next year. Also on the 2-year chart, we are expecting some downward pressure, so we target 1.85% by the end of this year. As we have a close call, we expect more a last cut by the ECB. We target 85 BP on the OAT bond spread, as we think that the political reach should remain high. And in this context, we don't think that we will see some strong spillover effect on the BTP curve, as we expect the 10-year BTP bond to stay at 85 BP, so trading flat versus the OAT. And I stop here.
Thank you very much, Théophile. It's not necessarily in this slide, but we have as well a negative view on the evolution of term premiums in Europe, having additional steepening in Europe, be it on cash or swap curve, notably on the back, of course, of this Dutch pension fund transition theme, which has been weighing a lot since the beginning of the year, even though the market positioning is probably kind of flyer as we speak. We had this correction over the past few weeks, but it's like well, we're having the same moment as in the US, where it feels that on the very long end we have a weaker appetite. Maybe DMOs will decide to decrease a bit the duration of their issuance program next year. We'll have to see, but in the meantime, we do expect additional steepening for sure as well in Europe. Thank you very much, Théophile. So let's switch now to the Q&A session, and I think we already received four questions, all on the US. So I will be starting with you, Chris and John, and maybe starting with the first question on this US stocks market, which is once again defying gravity and reaching record highs every single days. I think we have like 10 days of increase for US stocks. I think on the credit side, we have 9 days consecutive days of tightening. We know that this rally, this bull run on the equity side has been fueled by AI, notably. I don't know who want to start, but do you think it could last in a macroeconomic context in which the US economy is slowing down?
Sure. Let me just set the table from a macro perspective before tossing it over to John. I just want to say that the wealth creation that we've seen from the rise in equity prices has been one of the accelerants to consumer spending. So I do think that if we see a correction in the stock market, we would see an associated reduction in consumer spending. I'd also say that most of the infrastructure spending that we've seen has been on data centers and on AI. Not sure exactly what the capacity is for that, but there has to be a limit as to how much we can do there. In the short run, I will say that there is a little bit of an accelerant from the One Big Beautiful Bill. The accelerated depreciation for CapEx spending should, on the margin, add to more spending on infrastructure and equipment. So let me toss it over to John for his thoughts on this as well.
Yeah, so with the additional hedge that I'm a rate guy, talking about equity market and whether it's in a bubble or not, I think one difference between, say, now and the 2000 period is that in the 2000 period, you had a lot of companies that were skyrocketing that had no positive cash flow and weren't making money. Now, there's plenty of those in this cycle also. I own probably a good portion of them. But I do think that the the leaders in the segment do have, strong earnings and are generating huge amounts of cash. And so I think there's a little bit of a difference when it comes to comparing that bubble to valuations now. Now that said, I do think that there is reason for some caution. Now, on one hand, when you have expanding earnings and the Fed easing, that's almost always a very positive time for equity markets. On the other hand, when you've had valuations for the S&P up in the 22 times earnings range, that also almost always is a recipe for a pullback. So I think that it's a great question, probably without a great answer right now. I see it more likely not being a bubble that's bursting, but perhaps some longer term underperformance. Which sectors perform better or not, I think is a different question. As Russell take over with the Fed easing, as we saw, yet last 2 days, we saw good performance in small caps and stuff like that. But I think there's reason for caution. I just don't know if it's going to be a bubble burst type environment, as opposed to perhaps, we just have less gains or a sideways market going forward.
Thank you very much, John. For sure, our equity analysts based in Paris are still positive on US equities. As long as we keep this soft landing scenario in the US, they are pretty confident US equities will keep performing, notably just for the sake of having additional inflows. I think what's key as well for US assets in general will be by how much the US dollar will be depreciating ahead. I think it will be key in understanding by how much, in fact, notably for investors are spooked by the global context abroad. For sure, we had this year, of course, this couple of weeks during which we've seen all of these debates surrounding, in fact, the deglobalization and the derealization of the economies. Now, in Natixis, our view is that, yes, we do believe we'll have additional weakening of the US dollar, but we don't speak about a massive weakening of the currency. We do expect the DXY to lose like 3 figures during the coming year, and for the euro dollar to reach 119 by the end of the year and 121 by the middle of next year. So still a continuation of this weakening US dollar move we've seen since the beginning of the year, but not a catastrophe. So as long as, once again, we don't have let's say tail risk materializing, notably in the US, I think it's still rather safe to be long US equities, even though the dispersion of returns, Jen mentioned the sectors. The return of each sector will probably get bigger as the US economy gets weaker. And speaking about the potential boost and the factors behind this US economy, we just had a question on infras, and you mentioned infras, Chris, and their potential impact. How do you factor in fact, these massive investments we could have ahead? We are not really sure about how much cash will be invested, including by European in the US, not only in coming months, but how do you factor in this factor into your forecasting of inflation, labor, and GDP in the US?
Yeah, it's really a terrific question, and infrastructure spending or private investment is usually a very volatile component. So I'm just looking here. We saw it go up, 23% quarter over quarter annualized in the first quarter. That's not terribly unusual to get these pretty wide swings. So I don't think we should overreact to either a huge uptick or a huge slowdown on a quarter by quarter basis. But I will say that the tailwinds from the One Big Beautiful Bill are certainly there. Just tying in the other question that we had about why we have growth slowing down and we still have fairly strong investment spending, and that's primarily because we see the consumer sector slowing down. Not necessarily because we have unemployment spiking, but workers overall, and you see this in confidence indicators, workers are less confident in their ability to find new jobs. They're less confident in their ability to hold on to their current job, and in that instance, they're less willing to ask for wage increases, and they're probably not going to get them if they do ask for it. So it's more of a defensive increase in the savings rate that we're going to see, and the marginal swing that we see in growth stepping down a little bit isn't from any of the other components except for the consumer sector. So again, balance sheets in aggregate are pretty strong, but the marginal propensity to spend when you're not as confident in your job prospects is going to go down, and I think that's what's going to drive the below potential growth over the next few quarters.
Thank you very much, Chris. Maybe last question, and it's for you as well. I'm really sorry. It's about the Fed. So in our scenario, we're seeing the Fed cutting down to 3%, right? Now, our understanding is that the price action we'll have in the USD market will really depend notably on the pricing of the terminal rate. What would you need, in fact, in your forecasting to lower, let's say, your Fed fund rate target down to maybe 2%? It can be in terms of NFP figures, anything.
Sure. So one of the reasons why I don't have the Fed cutting, enough to provide accommodation, so below 3%, is that I do think overall consumer balance sheets look pretty good, business balance sheets look pretty good, and I don't see a spike in the unemployment rate. Partially because I mentioned before, because there is still a pretty big appetite for corporate investments. Now, if most of the investment increases that we've seen over the past year or so only pulled forward demand, and we don't see that demand keeping up in 2026, sure, I do think we could see an increase in the unemployment rate at that point. And if we do get more uncertainty about tariffs, for example, the debate about whether or not the tariffs that Trump had applied are legal is working its way through the U.S. court system now. Now, Trump has many different ways to get to the same effective tariff rate overall. He picked the most expeditious rate. So if the courts say that he can't use these emergency powers to apply tariffs, he's going to use other authorities to apply tariffs. That's going to take longer. That's going to cause more uncertainty for businesses and in the market. So it just prolongs the uncertainty when it comes to U.S. policy. So paradoxically, if the courts strike down Trump's ability to apply emergency tariffs, I think that is bad for growth because he's going to just attack the problem from a different angle, which is going to take longer to implement, and we're going to get to the same exact spot. So that sort of tariff uncertainty is one of the reasons why I think we could, potentially see the Fed cutting in that instance.
Thank you very much. I see that we don't have any additional question today. Well, I think we can probably call it today. Thanks to you, Chris and John, for joining today. We'll try to make it a bit more regularly to share the house views on the US market. We know that the focus is less so on Europe for now, hopefully even less so on France. I cross fingers. But for sure, we'll be speaking a lot more about the US in coming months. Thank you, guys. Thank you as well, Théophile, for your insights. And well, we speak very soon, probably next month for the next round of our monthly preview webinar. Thank you, guys. Bye-bye.